Hello, very good afternoon to all. Pardon me. Hello, very good afternoon to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be a brand new month of February, and we'll be starting Daily Dose at lunchtime hour, which is at 1 p.m. So very good afternoon to all, and I wish you all, hope that you guys have a great Chinese New Year, Lunar New Year break. And before we start our gist of today's Daily Dose of Market Insights, which is very interesting, given that what has taken shape over the weekend, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook on the broad-based cross asset classes, ranging from the US dollar major pair, the major stock indices, and the two key commodities that we cover on a daily basis, which is gold XAU/USD and as well as the West Texas crude oil. Let's have a recap of what has taken shape over the weekend and Friday, and most importantly, how does this particular news flow, event, and economic data impact the intraday performance on the broad-based cross-asset classes. So what we could see over the weekend over here was Trade War 2.0 has officially started. So what do I mean by this? On 1st of February, which is on a Saturday over here, Trump actually officially announced that the US will hit trade tariffs with its major trading partners, 3 of them for now, which is Canada, Mexico, and China. So Canada and Mexico got hit by 25% tariffs each. China managed to spare the what you call it, the gun at this point in time, where US only hit it with 10%, and this 10% may increase going forward. But what's interesting over here is that Canada and Mexico has really responded back to these trade tariffs by hitting US products going into Canada and Mexico by 25% each. So it's kind of a retaliatory move or counter tariffs to 25% as being imposed by Canada and Mexico on US products heading into these two countries. So far, China has remained silent, but China has started to sound a bit of displeasure by voicing their by bringing out their complaint to official channels like the WTO body, which is the World Trade Organization. And at this point in time, there is some pockets of hope saying that this particular tariffs may be reduced. Why? Because this tariffs is actually potentially only due over here. Though these measures will only take effect at 12:01 a.m. Tuesday, so we have about 24 more hours more to go, give or take. So that will be on a tomorrow 12:01 p.m. Singapore time. That is Tuesday over here. So what we could see, okay, sorry, pardon me. So they have only 12:01 a.m. Tuesday, that is US time. So it will be 12:01 p.m. on Wednesday Singapore time. All right, so it's because of the 20 kind of a 24-hour clock earlier. We are actually much earlier than US over here. So given the fact that there may be a risk of this we call it a further reiteration move if Trump do not get things that what he wants, and what we could see over here is that across the board the dollar starts to strengthen. This is the 5-day rolling performance of the US dollar against other major currency. And what's interesting over here is that the yen now is being used as a safe haven play. So what I could see over here is that the yen didn't actually weaken much against the dollar. So in fact, the dollar actually underperformed against the Japanese yen, only gaining by 0.47%. This is a 5-day rolling performance where it actually outperformed against the key commodities currency like Aussie dollar, which is up. The dollar is up against the Aussie by 2.4%, up by the Canada CAD, which is up by 2.4% as well, which is considered as a commodity related currency. And do not forget, Canada is one of the countries that's being directly hit as well. and the Kiwi traded very closely against the dollar, against the Aussie dollar, pardon me. The dollar actually strengthened against the Kiwi by 2.3%. And what you see over here is that the dollar also strengthening against the euro by 2.07%, being the fourth dollar outperform, where the dollar outperformed the euro, being the top four of them. All right. So why the dollar actually strengthened against the euro? Because there is actually pockets of rumors saying that the eurozone or European Union may be the next country that will get hit by US trade tariffs. So that actually saw the dollar strengthening against the euro. But however, later I'll touch on the short-term intraday technical outlook. The euro dollar has indeed came down as expected on before we went for our Chinese New Year break on Wednesday. We do see the euro weakness, but right now the euro is now came down to be very close to a key short-term or key medium-term pivotal support zone. So later I'll touch on the euro dollar short-term intraday technical outlook. All right. So what's interesting over here is that yes, the major US stock indices actually collapsed at the second half of, or the later half of the US session on last Friday. Still recall that on last Friday, before we went for our Chinese New Year break on Wednesday, we do expect a bit of bounce coming into play of the US stock indices. All these bounces hit our short-term resistance exactly before it shaped that bearish reversal on last Friday. So very nicely, the technical levels or the technical analysis on the US stock indices hold as per analyze on last Wednesday before we went to our CNY break. So it actually collapsed all the way to on last Friday. And what's interesting over here is that in today's Asia session, which is the E-mini futures, you can see my screen over here, and the Nasdaq futures, both of them are actually down by close to 2% for the E-mini S&P futures, and the Nasdaq E-mini future is down by negative 2.6% as we are speaking right now. And that actually spread across the we call it Asia major benchmark indices to be in the red. So the worst hits was Nikkei 225, which is down by negative 2.9%. This is due to the fact that the Nikkei 225 do have a significant weightage on automobiles like Honda and Toyota, which is particularly sensitive to trade tariffs. It will be a chain impact, even though there's no trade tariffs being hit on Japanese automobiles. And what's interesting over here is that the Hang and the Hang index, as well as the HSCI, the H shares, followed by the China A benchmark A shares stock index, which is the CSI 300, is down by a lower magnitude. And what's interesting, let me share you the technical chart of the Hang. So this is the Hang technical chart over here. Okay, if you look at my screen, what I could see is that yes, this morning it gapped down after a 3-day break during the Chinese New Year break. It also closed on Friday. Intraday loss, the maximum drawdown is 2.28%, and right now is actually trading slightly we call it at a lower magnitude of negative 1.13%. So it seems to us that this earlier intraday sell-off of negative 2.3% managed to find support at this 50-day moving average. So later I'll touch on the instrument that is being, we call it traded in our platform. We call it the Hong Kong 33. What is the short-term key technical level to look out for and the trend bias for today. All right, and one particular news flow also potentially impacting this Hang and the Hang indices managed to find some support at the 50-day moving average. It was because of this China Caixin manufacturing PMI that was released much earlier today at 9:45 a.m. It actually came down slightly below expectation at 50.1, where previously it managed to actually shape a recovery to 50.5. So if you look at the trend of the Caixin manufacturing PMI, okay, give me a couple of seconds for it to load. Okay, great. So previously, what you could see over here is that it's tried to actually struggle to shape any meaningful recovery. So if you look at the 3-year trend, okay, it's still hovering in the sideways range, and right now it's now threatening to inch back below the 50 level mark. All right, so by registering a 50.1 level below market market slightly below what market is expecting at 50.5. So what I could see over here is that the manufacturing industry, which is also being key on churning out exports for the external economy of China. And you look at the entire last year, China growth has been much more driven by industrial production. That means, i.e., producing goods for the rest of the world, and which the manufacturing PMI, this Chinese manufacturing PMI is also used as a gauge to gauge how well China industrial activities will be. So if you look at now the situation of here for the month of January, it starts to slow down to 50.1 almost. If it goes down to inching down to get miss the growth of the manufacturing activities in China is getting lesser and lesser compared to the month of November, December versus January. So what it means that over here is that the uh, external factor or the external economy that is driving China growth for last year has started to flatten as well, or turn lackluster, and that will actually lead to more urgency for China top policymakers to be much more mindful in giving out what I call it stimulus measures rather than giving up pure rhetoric, but they now got to actually show their real hands on what is the amount that is going to be dedicated or targeted towards consumer spending that potentially could boost sentiment and consumer behavior over here. Because right now the external side of the growth sector that has been driving China growth last year has started to flatter off. All right, so that also explains why the China HSCEI managed to actually recover from the earlier sell off in today's early Asia session at the open, because of this anticipation that the China top policymaker got to now come up with much more forceful fiscal stimulus. Number one is to actually boost consumer sentiment, because given that the external sector now has starts to feather off, and as well as to negate US trade tariffs that's being targeted on China as well. All right, so now that's actually that one more particular particular things on share with you is pertaining to during the CNY break. We have the Fed FOMC meeting, and during the FOMC meeting, this is particular exposed FOMC meeting what is market is now expecting on the Fed funds futures market as being calculated by the CME Fed Watch 2 on my screen here. So based on the CME Fed Watch 2, based on latest pricing as of Friday over here, is that market now see a high chance that the Fed will still remain on hold in the next upcoming FOMC meeting on 19th of March 2025. So high chance of a 2.5%. Market is now expecting the Fed to maintain the current Fed funds rate at 4.25% to 4.5%. And the reason being that during the press conference of last Wednesday, just concluded FOMC meeting, Fed Chair Powell actually sounded that inflation risk may be back subtly, all right, because in the monetary policy statement, they actually removed this particular sentence saying that inflation trend in US is trending towards that 2% desired target set up by the Fed. They removed that particular statement. And that actually means that subtly the US Federal Reserve officials are pretty much concerned about resurgence of inflationary pressure coming back into the US economy, boomerang by Trump's policy, which is these trade tariffs potentially will lead to we call take for that measures, which we just now seen Canada and Mexico retaliate by introducing 25% tariffs on US products heading into their respective countries, and as well as the impending widening of the US budget deficits by this looming Trump steep corporate tax cuts as well, which could be inflationary resurgence in nature, given from a medium-term perspective. And what's interesting over here is that if I were to actually look at from the aggregated approach, where we start to see the pricing of the Fed funds futures contract across the different calendar month of the various respective US Federal Reserve FOMC meeting. So for sure, the next meeting very likelihood the high chance will only come for another rate cut this year will be in 18th of June 2025, given a high chance of 84%, and thereafter it starts to remain the same at 4% to 4.25%, and only potentially there may be a cut coming in at 10th of December 2025 meeting. That means towards the last meeting of 2025 at 10th of December, the Fed may introduce another cut because market is now pricing in a chance of 68% or 69% that the Fed funds rate will be reduced by another 25 basis points to 3.75 to 4% before the year's end. And what's interesting over here, after this potential expected rate cut based on the current pricing of the Fed funds futures market, the market participants in this interest rate market, or I would say that the Fed funds futures market, doesn't think that the Fed will continue its interest rate cut cycle for 2026, and what markets being priced that they attempt to actually stamp at all the way until the 9th of December 2026. That means that for the entire year of 2026, market participant right now does not expect the Fed to cut at all. That means there's a risk that if lagging economic data like the US CPI, the PCE data starts to show signs of economic resurgence coming back into picture in the next 3 to 4 months, there could be a risk that market participants right now may start to price in the next interest rate hike cycle, not cut cycle, the next interest rate hike cycle maybe take place or take shape in 2026. So overall net, this is actually a liquidity tightening situation. Number one, US stock indices may face a bit of pressure, at least in the medium term perspective, given that the last year or so we see very high, richly PE ratio for the Nasdaq 100 and the S&P 500, and given that this lesser chance of the US Federal Reserve to actually be much as to be dovish this year versus last year, that also tell us that the major and medium term US dollar strength continues to remain intact. So if you look at the US dollar index over here, it actually rebounded very nicely ahead of the US tariff official we call enactment by US President Trump on the previous Saturday. In fact, it started to show signs of a bullish reversal on the 27th of January and the 28th of January over here, which I highlighted earlier on in the previous daily dose on these 2 dates. And right now it's inching up towards the 1111 resistance level. So very nicely, it has continues to trade higher with a series of higher high and higher low after this we call it this major range resistance breakout on the 12th of November. All right, of this year at this point in time, and the RSI also managed to actually inch higher as well and hasn't hit the overbought region yet. Yes, on an intraday basis, may see a bit of pullback here and there, but from a medium term perspective and a major trend horizon perspective, that's multi-month perspective, the dollar strength still remains intact over here by looking at the daily chart, latest technical elements on the US dollar index. All right, so with that, now let me now touch on the intraday technical outlook on the various broad-based cross asset classes that we do on a daily basis, starting with the FX market first. But before that, let me expand my screen so that you guys, as usual, could see the key levels much more clearer. So let's start with the FX market with the euro dollar. All right, so euro dollars, if you still recall on last Tuesday before we go for our break, we have a bearish bias. It hit our support level at 1.0270, and right now it's coming very close to the 1.02 figure, 1.0119 medium term pivotal support level, which is the key medium term swing low of 13th of January 2025. So with that, given that it's now at the key support medium term support level, and the RSI now is back to a kind of a relatively low of a high oversold region at this point in time, there could be a risk of a counter trend rebound taking shape. All right, so I will turn neutral first for today at 1.0270, lower limit of the neutrality range at 1.02 figure /019, for now, with a risk of a counter trend rebound, at least on the intraday basis. So with an hourly close above 1.0270, potentially a minor intraday counter trend rebound may take shape on the euro dollar. Why? Because price action is now hovering at a key medium term support level, and the hourly RSI is kind of a closely oversold reading as well. Above 1.0270 with an hourly close above it exposes the next intermediate or near-term resistance level at 1.0340, which is the upper limit of today's gap down, and close to the 20-day moving average, acting as a similar key intermediate resistance as well at 1.0340. Only a breakout above 1.3040 may see the extension of this potential intraday mean reversion rebound, exposing 1.0440 / 1.0460 next, which is the key congestion area of 29th of December and 30th of January, where it shaped that bearish reaction and so close to the 50-day moving average as well. However, if price action starts to fail to actually do that mean reversion rebound and starts to tumble during the European session, because right now 2 more hours the Euro session will open, an hourly close below 1.0190 will starts to see the higher probability of the continuation of this impulsive down move of the euro dollar, exposing the next near-term support at 1.0090, which is the one-time Fibo extension level over here. And as well as graphically, if you look back in time, let me go to the daily chart so that you guys could have a better view. Okay, is this former minus swing high of 26th of this October and 8th of November now turns into a pullback support level as well, okay, at the 1.099 level. All right, so that's for the euro dollar, okay, with the possibility of a potential intraday mean reversion rebound if we have an hourly close above the upper limit of this neutrality zone at 1.0270. All right, now turning on next will be its cousin, the sterling dollar. So still recall that the sterling dollar hasn't even hit the medium term swing low of 13th of January yet. Still got some more room to go. So with that, potentially, yes, we may see a bit of pullback or back towards this former minor descending trend line now turns into a pullback support, given the fact that the hourly RSI also has slipped to a oversold region. So as long as this potential a pullback or snapback didn't surpass above the lower limit of the gap down, which is at 1.2325, which is our short-term pivotal resistance for today, we tighten it downwards. And still recall last Friday we will have a bearish bias and almost hit our bearish bias support level at the 1.2230 mark. All right, so with that, we will still maintain that intraday bearish bias on the sterling dollar, given that it hasn't hit a medium-term support level at 1.21 figure level. Yes, there may be a bit of sign of a bounce, given that the hourly RSI has slipped the oversold region. So we'll be using 1.2325 level as my short-term pivotal resistance level. As long as this bounce didn't surpass above 1.2325, we will maintain the intraday bearish bias on the sterling dollar. Next near-term support level to watch on the intraday basis will be 1.2160. A breakdown below it exposes the medium-term support level at 1.21 figure level. However, if the bounce starts to surpass above 1.2325, then potentially the sterling dollar may starts to unfold a potential mean reversion rebound scenario as well, exposing the upper limit of the gap down for today at 1.2390. Above it, potentially revisit 1.25 figure level, 1.2520, which is the congestion area of 27th of January and very closely to the 30th of January as well, and the 50-day moving average also acting as a similar resistance zone. Right, so that's for the sterling dollar. Now, turning our attention will be the Aussie dollar. So the Aussie dollar also plummeted as expected and hit our support level as well, which is the 61.20 level, and now coming very close to the 60.55 / 60.30 level. So this level graphically, if you look at the daily time frame chart, other than the Fibo extension level, it actually comprises very close to this area here, this congestion area of 3rd of April, and also the close to the Fibo extension of 1.618. If I take it from all the way up from the high of 30th of September, project it to 7th of November. Now back to the hourly chart over here. So given that the hourly RSI now has started to exit from a extreme oversold level, we will now flip to a intraday bullish bias on the Aussie dollar, also looking for a scenario where the Aussie dollar could potentially shape a intraday mean reversion rebound scenario, given the very steep sell-off that we start to see in today's Asia session, leading to extreme oversold condition on a short-term basis. So with that, 60.55/60.30 short-term pivotal support level for the Aussie dollar, flip to a intraday bullish bias for today on the Aussie dollar. Next near-term resistance level to watch will be the gap resistance at 60.20, 61.65/62 figure level. And if you do the Fibo retracement of the entire sell-off that has taken shape since last Friday all the way to today's Asia session low, that also corresponds to the 50% and the 61.8 Fibo retracement as well. Only a push down with an hourly close below 60.30 short-term pivotal support will invalidate today's intraday mean reversion rebound scenario to resume its impulsive downward sequence, exposing the next near-term support level at 05990. Below it sees 05920 next. All right, so 05920 and 059 figure level is very close to this graphical area here. Okay, of swing low of a 7th of April and the psychological 60 cents level, and the minus swing low of 25th of March at this point in time. All right, so now with that, we will flip our, so net overall in a nutshell, we'll be using 60.55/60.30 as my short-term pivotal support level, and given its grossly oversold condition on the hourly RSI, there could be a possibility of a intraday mean reversion rebound that may take hold on the Aussie dollar. Now, turning our attention will be the dollar yen. Still recall that the dollar is one of the weakest currency against the yen. That means, i.e., yen is being used as a safe haven appeal in this ongoing risk-off scenario that's being seen on the major stock indices. Right now, it's now coming very close back to the 20-day moving average that is now acting at a resistance level at the zone of 15650/80. So we will tighten or tidy our key short-term pivotal resistance level for the dollar yen. Still recall that on last Wednesday or last Tuesday, before we went for our CNY break, we have a bearish bias on the dollar yen, and the dollar yen almost hit the previous minor swing low of 27th of January. So with that, right now it's already managed to rebound and come very close to the 20-day moving average that's still sloping downwards. So we will be now maintaining that intraday bullish bias, given that the price already bounced off during the Asia session, left a bit of room more before hitting the short-term pivotal resistance level. So with that, we'll be potentially using this zone over here to fade any potential strength to maintain that intraday bearish bias, given that tit for tat regulatory measures by countries that's being hit by US trade tariffs may be risk averse in nature, and that could potentially see yen as a safe haven currency and causes the dollar yen to be much more muted against the dollar pair with the rest of the other currency. And don't forget over here is that the euro dollar and the euro dollar, the Aussie dollar both has hit kind of an extreme oversold level. So there could be some signs of dollar strength setback in these two pair as well, which could potentially reinforce this weakness on the dollar yen. Okay, conversely. So with that, 15650/80 short-term pivotal resistance level on the dollar yen, confluence with the 20-day moving average that's sloping downwards, maintaining our intraday bearish bias, but we have a higher two support level to watch out for today, 15480, a breakdown below it, revisit 15370 next. Only a push up and hourly close above 15680 will invalidate today's intraday bearish bias on the dollar yen and potentially see a squeeze up to revisit 15770, which is the minor congestion area here of 14th of January and 15th of January, and also confluence with the 76.4 Fibo retracement if I were to use the previous sell-off from 10th of January all the way down to the 27th of January low. All right, so that's confluence with the 76.4 Fibo retracement of that previous, we call it minor sell-off on the dollar yen. So with that, net still maintaining that intraday bearish bias on the dollar yen as long as 15650/80 short-term pivotal resistance is not surpassed to the upside. And one more particular FX market analysis I share with you is more on the crosses over here. So let me share with you a particular cross that has an interesting configuration, will be the Euro Swiss cross pair. So this Euro Swiss cross pair tends to be much more we call it impacted by this risk on risk off scenario as well. But however, now the hourly RSI has really hit the oversold level, and with it coming very close to a first support zone at 93.55/93.40, there could be some signs of a potential bounce taking shape going forward in today's European session, and perhaps may start to hit up into the US session as well. But as long as this bounce over here didn't surpass the 94.20 short-term pivotal resistance that I have for today, that means potentially after hitting into this region over here, there could be chance of a bearish reversal taking shape again on the Euro Swiss pair. And if I were to do the Fibo retracement of this recent sell-off from last Thursday all the way down to today's Asia session low, it's coming very close to the 50% Fibo retracement as well. So as long as this bounce didn't surpass 95.20, we will have a bearish bias on the Euro Swiss going forward for the next from a multi-day perspective. Over here, below 93.40 exposes the next near-term support level at 93.10, which is the minor swing low area of 23rd of December last year. Only an hourly close above 94.20 potentially invalidate the multi-day bearish bias on the Euro Swiss to see it trading upwards towards the upper limit of the range resistance level, resistance at 94.80, followed by 95.10, which is the key medium-term pivotal resistance, which confluence with the 200-day moving average as well. So this particular Euro Swiss cross pair that I highlighted could be used. We could monitor it from a multi-day perspective using 94.20 as my short-term pivotal resistance, given potentially from an intraday basis there could be some signs of bounce heading up towards the 94.20 short-term pivotal resistance level for the Euro Swiss cross pair. Now with that, let us now turn our focus towards the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 managed to shape a bounce and survive right again at the 20 and the 50-day moving average, confluencing with a graphical minor swing low of 23rd of January at 19,685. So we'll be using this 19,685 as my short-term pivotal support for today. So we do have a bullish bias because it managed to survive and shape a bullish hammer candlestick as well. First resistance to watch for here will be the gap down at 20,170. Above 20,170, revisit the next resistance level at 20,520, which is potentially last Monday minor swing high. Only push down and the hourly close below 19,068.5 will invalidate today's intraday bullish bias to see the continuation of a minor corrective pushback or push down to expose the next near-term support level at 19,350, followed by 19,150 next. So that's for the Hong Kong 33, using 19,685 to have a intraday bullish bias for today. Right, so now turning our attention next will be the Japan 225, which represent the Nikkei 225. If we could recall previously on last Tuesday, before we went for our CNY break on Wednesday, we do have a bearish bias, so-called floating down back towards the lower limit of this sideways range configuration, minor sideways range configuration that is in place since 13th of January this year. So if you recall that for the Japan 225, it's actually trading within a range. So since the low of 27 or 27 of September, it has been trapped in this kind of complex sideways range configuration. And right now, given that the hourly RSI is now really hit a extreme oversold level and is now coming back down towards the minor range configuration within its medium-term range configuration kind of a situation. So with that, I'll be using this 38,140 as my short-term pivotal support level. So we will flip to a intraday bullish bias for it to actually potentially float up towards the upper limit of this minor sideways range configuration. next near-term support level to watch on the intraday basis will be at 38,655. A breakup above it exposes 38,960 next. All right. However, if the price action starts to push down, if an hourly close below 38,140, then we will start to see the continuation of this minor impulsive downward sequence within its medium-term range configuration, heading downwards towards the lower limit of the medium-term range support area, 37,700, followed by the key medium-term support range support level at 37,330. If we go back over here, yeah, this is the 37,330 that has been in place since 27th of September. All right, so using 38,140 for a potential short-term pivotal support for a potential mean reversion rebound scenario, with two key resistance levels to watch on the intraday basis will be 38,655, which is confluence with the 200-day moving average. Above it exposes the next near-term resistance at 38,960, which is very close to today's gap down, the lower limit of today's gap down as well. So that's for the Japan 225. Now with that, let us focus now on the Europe key major stock index or the benchmark index, which is the German 30. So the German 30 plummeted down, it gapped down over here, and is now coming very close to the 20-day moving average that is acting as a support level at 20,940 level as well, and also forming the previous minor congestion area of 17th of January and 21st of January. And given that the hourly RSI now is at a grossly oversold level, there could be some kind of bounce taking shape for the German 30 on the intraday basis once the European session opens. So we'll be using 20,940 as my short-term pivotal support level to watch this support level to potentially maintain a intraday kind of a intraday bullish bias for a potential minor recovery. First resistance level to watch 21,440 followed by 21,625. So all these two zones here is actually the gap resistance that is being formed right now. Okay, only a surpass above the gap resistance of 21,625 will potentially remove the all danger sound to see a much more higher probability for it to continue its impulsive up move sequence. But however, if it starts to actually have an hourly close below 20,940, this could potentially prelude in a potentially medium-term corrective decline sequence. But in first step, it may expose the next near-term support level on the intraday basis below 20,940 on the hourly close below it exposes 20,720 followed by 20,500 next. So net overall, we'll be using 20,940 as my short-term pivotal support today, which confluence with the rising 20-day moving average for a potential recovery, intraday recovery scenario. But resistance level to watch on the intraday basis will be the gap resistance at 21,440 followed by 21,625 for the German 30. Now flipping our attention next will be the US Wall Street 30. So US Wall Street 30, it rallied and almost hit our short-term pivotal resistance level on last Tuesday before we went to our Chinese New Year break. So at the point in time, we do have a bullish bias for the US Wall Street 30. So it already hit this resistance level at 45,090/100 before it starts to tumble in last Friday and in today's Asia session. And right now it's coming very close to the 50-day and the 20-day moving average, confluencing with a graphical support zone at 43,730, 43,600. And if you do the Fibo retracement of this previous up move from 13th of January all the way up to the high of 31st of January, which is last Friday, it also confluence with the 38% Fibo retracement as well. So with that, I will be still maintaining that intraday bullish bias for today, given that price action really gap down and it's coming very close to a key turning point or a support level or a pivotal support zone, 43,730/600 short-term pivotal support zone area. Maintain the intraday bullish bias for today at US Wall Street 30. Intraday resistance level to watch for today, there'll be two: 44,095 followed by 44,515, which is the gap down. Okay, this massive gap down over here. Only an hourly close below 43,600 will invalidate today's intraday bullish bias to see a prelude to a much more medium-term corrective decline sequence. But in first step, the next support level to watch will be at 43,095 below 43,600, which is the minor swing low area of 16th of January. 16th of January, yeah, over here. Now, with that, let us now focus our attention to the Nasdaq 100. So the Nasdaq 100 also rallied as expected, slightly surpassed our resistance level, which is the previous gap down at this 21,730, which is on Friday. It hit, and after that it reintegrate back below it. So with that, right now it's coming very close to the minor swing low area of 15th of Jan and 27th of Jan 2025. So I'll be using this level here, 20,690 as my short-term pivotal support level, looking for a potential intraday kind of a recovery scenario, rebound scenario, at least on the intraday basis. Next resistance level to watch on the intraday basis will be this minor swing low here at 21, former minor swing low. It gapped down in today's Asia session, will be at 21,125. Let's put it in writing, 21,125. All right, above 21,125 sees 21,300 next, which confluence with the 20-day and the 50-day moving average, I think, as a similar resistance area as well. So using 20,690 short-term pivotal support level, potentially for on the intraday basis, there could be a mean reversion rebound scenario taking shape. 21,125 first resistance level to watch, second resistance level to watch 21,300 on the intraday basis for today. Only a push down and a close below 20,690 potentially kickstart a medium-term corrective decline sequence, given that price action has now start to lift below the 20-day moving average and the 50-day moving average after this failure rebound last week that to take shape. All right, and you recall last week we also see this as a mean reversion rebound scenario as well. So below 20,690, hourly close below it, potentially kickstart a kind of a medium-term corrective decline sequence for the Nasdaq 100. Next near-term support level to watch for today, if 20,690 does not hold, will be 20,530, followed by 20,335 / 20,290. Okay, which is the minor swing low area of 15th of November and 20th of November. Okay, so that's for the Nasdaq 100. And now let us now flip our attention to the commodities market over here, starting with the gold XAU/USD. So for gold XAU/USD, managed to rally and hit our resistance level before we go for our Chinese New Year break and surpass the previous former all-time high at 2,790. So the previous resistance level that we highlighted at 2,790 is 2,812, followed by 2,820, which defined by a clustering technique using Fibo extension level, hit exactly and shaped that pullback on last Friday and heading into today's today's Asia session. So with that, the hourly RSI also managed to bounce close to the oversold level as well, and right now it's coming very close to a pivotal toward the lower limit of this minor ascending channel that is in place since the low of 30th of December last year. So the first support level to watch will be 2,765. I don't want to use it to put it so tight at 2,765 because of the volatile nature of the market today, given this kind of rather impromptu trade tariffs narrative that is still taking shape. I will use a slightly lower level, which is 2,745, which is the minor swing low of 30th of Jan, managed to survive from the former minor swing high of 28th of Jan. 2,745 as my short-term pivotal support level. Maintain that intraday bullish bias for gold XAU/USD, potentially above 20,790, may revisit 2,012 / 2,820 for today. Above it sees 2,838 / 2,840, which is the upper limit of this minor ascending channel. Only an hourly close below 2,745 may see the extension of today's minor corrective down move sequence, exposing the next near-term support level at 2,728 / 2,719, which correspond to the rising 20-day moving average as well. So net overall, still maintaining that intraday bullish bias on gold XAU/USD, using a slightly lower level than the first support level at 2,765, 2,745 as my short-term pivotal support level to maintain that intraday bullish bias for gold XAU/USD. So lastly will be the lastly, pardon me, will the instrument to watch out for will be the West Texas crude oil over here. All right, so West Texas crude oil, I believe should be here. Yeah, so, where is it? Yeah, West Texas crude oil. So West Texas crude oil rallied as expected on this Monday in today's Asia session. It hit our support resistance level that we highlighted on last Tuesday, where we do have a bullish bias. So once it hit this resistance level, and which is the 20-day moving average, I think as we said as well, it shaped that bearish reversal candlestick formation. So with that, we'll now flip back to a intraday bearish bias for West Texas crude oil over here. So using 75.75/76.16 as my short-term pivotal resistance zone, flip back to a intraday bearish bias for West Texas crude oil. First support level to watch will be very close to the 50-day moving average, I think, as a support level at the minor swing low of last Friday, which is 72 figure level, 72.70, right? 72.70, yeah, figure level. A breakdown below 72.70 potentially exposes the next near-term support level on the intraday basis, which is 72 figure level, which is the psychological level, and as well as the minor congestion area of 2nd of January and 31st of December. All right, only an hourly close above 76.16 short-term pivotal support zone upper limit will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound scenario, exposing the next near-term resistance at 77.40, followed by 78.90 if 77.40 is taken out on the upside. So net overall, we will flip back to a intraday bearish bias using 75.75/76.16 short-term pivotal resistance level for West Texas crude oil. All right, so that also covers the intraday technical outlook on all the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key things to look out for today? Okay, so in terms of economic calendar over here, during the European session, we will do have at 6 p.m. The preliminary figure or the inflation rate for Eurozone that will be out at 6 p.m. Singapore time. That could potentially impact the euro dollar because market expecting the core inflation rate to come in slightly lower than the previous month of December at 2.6% year on year. Then thereafter, during the US session, we have the all-important ISM manufacturing PMI data and the subcomponent with the ISM manufacturing prices subcomponent where it continued to inch higher in the last few months. Market is expecting a further uptick to 52.6. So if the ISM manufacturing prices subcomponent goes much higher, that could actually prevent the Fed to become lesser and lesser dovish for 2025. That means potentially lesser chance of a much more deeper interest rate cut cycle. And if this manufacturing price subcomponent is considered as a leading inflationary indicator or one of the leading inflationary indicator to gauge US inflation trend start to continue to tick higher, potentially the market may adjust. The CME Fed Watch 2 may only show one interest rate cut for this year. So overall, that could actually be positive from the US dollar strength perspective, from a medium-term perspective. So something to look out for at 11 p.m. Singapore time. And also for today, the time is not being announced, but usually it's around the US session start. That means Singapore time, maybe around 10 p.m. to 11 p.m. That is the conclusion of the OPEC Plus ministerial meeting. So that could potentially impact the West Texas crude oil as well, because in the last few meetings, OPEC Plus members has been less hesitant to introduce more crude more barrels into the market. Why? Because they do not want to see crude WTI prices to actually plunge, given the uncertainty surrounding the global economy right now. At the point in time, the few meetings was due to China deflation, and right now is potentially due to the negative growth aspect from US trade tariffs hitting towards her major trading partners. So something to look out for the conclusion of OPEC Plus ministerial meeting today. Time is not confirmed yet. It's roughly usually based on past meeting. It could be somewhere between 10 p.m. to 11 p.m. Singapore time. And also on top of that, we do have the US earnings seasons that is continuing over here in the next this week itself. US earnings. So for today, we do have at the close of the US session, Palantir Technologies will announce the result after the close of today's US session. So that's about 5 a.m. Singapore time tomorrow morning. That could also potentially shape the sentiment of Nasdaq 100 as well, given that Palantir Technologies is kind of a key technological stocks that have a potential feedback loop impact on the Nasdaq 100. Something to look out for today at the close of the US session. That means in tomorrow after 5 a.m. Singapore time. All right, so with that, sum up to today's daily dose of market insights. So have a great day ahead, and we shall speak again at the new timing of 1 p.m. tomorrow. Thank you.